now. This is your BPP book for BPP kit for SBR, strategic business reporting, and it's the same thing. Actually, the theoretical thing I've already explained you. What we are going to do here, that we need to see, this is level 1 input, level 2 input, level 3 input. I've explained you active market, principal market, most advantageous market, and we want to see some example. Let's suppose this is illustration number 5. It says that principal market versus most advantageous market. An asset is sold in 2 different active markets at the following prices per item. So this is one particular item, one particular asset. In European market, the selling price is 53. The transportation cost to the European market is $3. It comes 50, and then there are some transaction costs. The selling cost are 3, so it comes as 47. The same asset, when it goes to the North American market, it will be $54 selling price, a little bit higher, but transportation costs are more, $6 and 48. And then there are some transaction costs too, and the net amount is 46. So it says that the principal market, now remember here, so this was your 2 markets, European and North American. The principal market, the one with the greatest volume and level of activity, the one with the greatest volume and level of activity is the North American market. The company normally trades in the European market, but the company generally trades in the European market, but it can access both markets. So you are usually trading in European, but the principal market is the US market. You have access to both of them. The fair value of the asset is therefore $48 per item, $48 per item. Where did I take 48 from here? I'll explain you how I'm taking it. That is the price after taking into account the transport cost. Transportation cost we have taken in the principal market for the asset. If, however, neither market were the principal market, I mean, you should remember that when you take principal market, in principal market, you only exclude the transportation cost, okay? Transaction costs are ignored, only transportation cost. If, however, neither market were the principal market, the fair value would be measured using the price in the most advantageous market. So in the absence of the principal market, you look for the most advantageous market. And now, which will be the most advantageous? The most advantageous market is the European market after considering both transaction and transport cost, which is 47. You should remember that in case of most advantageous market, you have to deduct both of them. You have to deduct the transport and you have to deduct the transaction. So when you deduct transportation cost, it becomes 47. When you deduct this, it becomes 46. So this one, 47 is there. 47 in the European market versus 46 in the North American. So you take the European market as the most advantageous market. And so the fair value measure would be $50 per item, less fair value is measured before transaction cost. So you take it, consider it as would be considered before the transaction cost. So you take it as $50. This is going to be your most advantageous market. You compare the 2 numbers. This market, you have to maximize. This market is giving 47. This market is giving 46. So the most advantageous market is European market. And you will say that 53 minus 3, 50 you will take as the fair value. Okay. For valuation purposes, you will deduct both of them. In the most advantageous market, for valuation purposes, you will deduct the transaction cost and the transportation cost and the transaction cost. This one is given higher. So it means that this is going to be the most advantageous market. And then within most advantageous market, you will say 53 is the selling price and 3 is my transportation, and you deduct it and becomes 50. And 50 will be treated as the fair value. 50 will be treated as the fair value in the absence of the principal market. But if you have the principal market, if you consider that North American market is the principal market, then you will say 54 minus 6, 48. Okay, this is one simple example. Let's see if there is one more example or not. Let's see what is the highest and best use. Illustration number 6, highest and best use. An entity acquires control of another entity which owns land. The land is currently used as a factory site. The local government zoning rules also now permit. So there is some change in the rules. Also now permit construction of residential properties in this area. Okay. So before it was a factory land, before you were using the land as a factory, but now you have permission to use this land as residential construction, subject to planning permission being granted. Apartment buildings have recently been constructed in the area with the support of the local government. Market values are as follows. Value in its current use is 20 million. Value as a development site, including uncertainty over whether planning permission would be granted or not. So this is the valuation for construction site. So if you are using the land currently as a factory, the valuation is 20 million. If you say that we are going to use the land not as a factory, but for construction of residential property, and there could be some uncertainties, considering those uncertainties, still it is 30 million. And demolition cost to convert the land to a vacant site, because you have some construction there and you have to, restoration and demolition, 2 million. The fair value of the land would be 28 million. Okay. 28 million, 30 minus 2, as this is its highest and best use. This is what you call highest and best use, that you have to recover most. If you remember when we were doing our IS 36 impairment, we said that recoverable amount, that what best you can take out. So it's almost a similar type of notion, that what maximum you can take out from the asset. This is called highest and best use. So the best use of the asset is 28 million. So the fair value will go as 28 million. Then do one more illustration. One more. So let's see one more example. Illustration number 7. Fair value of a liability. Energy company assumed a contractual decommissioning liability when it acquired a power plant from a competitor. So they purchased some power plant, and along with the power plant, there was a liability also, because probably the construction required restoration or decommissioning or demolition. The plant will be decommissioned in 10 years time. So this is a liability, and you have to measure the value of this liability. So assumptions made by energy company equivalent to those that would be used by market participants, assuming energy company was allowed to transfer the liability, are estimated labor, material, and overhead cost. Either it could be 6 million, or it could be 8 million, or it could be 10 million. So there are 3 estimates, and there are respective probabilities for these 3 different estimates. Okay. So, I mean, not all 3 of them will happen, either this or this or that. So it is like 3 different options. So third-party contractors typically add a 20% markup on the industry and expect a premium of 5% of expected cash flows after including the effect of inflation. So that's it. Now it looks very interesting. Okay. So what is happening? So there are some costs. These are the costs. 6, 8, 10, but you have to multiply. So 6 million multiplied by 40% plus 8 million into 50%, we will find out the expected value. So this can happen, or this can happen. 3 possible outcomes. If you remember the concept of expected values, we will use that here. And then it says that third-party contractors typically add a 20% markup and expect a premium of 5% of the cash flows after including the effect of inflation, and to take into account risk that cash flows may be more than expected. Inflation is supposed to be 3% annually on the next 10 years. The risk-free rate, interest rate for a 10-year maturity is 4%. An appropriate adjustment to risk-free rate for energy company non-performance risk is 2%. So this is risk-free rate, but you know that we never use the risk-free rates. You have to add the adjustments. Giving entity-specific discount rate is 6%. So 4% is the market risk-free rate, but for this particular entity energy company, the discount rate becomes 4 plus 2, 6%. Calculation of the fair value of the decommissioning liability. So first is expected cash flow. Like we said, that 6 million into 40% plus 8 million into 50% plus 10 into 10%. So expected value of liability is 7.4 million. This is the cash flow. Then there is a third party markup. The 7.4 million multiplied by 20%, which is this, and you come out to be 8.8 million. Then you have to make inflation adjustment. This is in terms of today. Okay. It's 3% for 10 years. Okay. 3% 10 years. You grow 3% into 10 years, and minus this number, it gives you this difference of inflation. I mean, because you are adding, that's why you are subtracting, because this number is already here. That's why you subtract from here, 8.8 million. Because if you make it 8.8 into 1.03, it will give you this number. Okay, it will give you this 11.094, because they just want to show it separately that this is inflation. So that's why you subtract. If you do not subtract, you can directly come to this number. So now after inflation adjustment, it is 11.934 million. Then you have a risk premium of 5%. This is given here, expect a risk premium of 5%. You take the risk premium of 5%, which is 500,000, and fair value of it is 12.53 million. Then 12.53 million, now you have to discount it. You have, because first you inflate it. If you remember, you are inflating it at 3%. Now you have to discount it at 6%. So you are calculating the present value. So you go like this. So this number you actually calculated here, this 12.531 is here. Because you took 7.440, then you added up some markup, you added up some risk premium, then you inflated it. You inflated it and it became 12.5%. You inflated at 3%. But now you are going to discount it at 6%, which is your discount rate. 6% is the market inflation. You discount it at your own rate, 6%. So 12.531 million divided by 1.6 power 10 years present value, and it is 6.997 million. So that's pretty interesting question. You have to consider, you have to see that which numbers you are using and where. I will repeat it again. This is 7.4 million expected value, very simple concept. You add up your 20% markup, it becomes 8.22. So this is the cost. This is what these contractors usually they charge. So this is in terms of today, it is expected that they will charge today. And then we make inflation adjustment here, because there is some 3% inflation for 10 years, it becomes 11.934. But there is possible that there will be some risk premium, which means that maybe 5% plus minus cash flows could be more, cash flows could be less. So you add a further 5% on that. So you get a number in future. This is the future value. And then this future value, you discount it to find out the present value. So this is how it was done. And so what you do, that first you inflate it, and then you discount it. You may be thinking that why do I need to do that? If I have to come back here, then why in the first place I inflated it? Maybe I don't inflate it. You need to inflate because inflation is done at 3% and discounting is done at 6%. So there is a difference. And that is why if you see the value is so small, because you're doing it at 6% discounting. Otherwise it was 8.8 million. So this will go as your present value of the liability. And then you remember that you have to unwind that liability so that in 10 years time, it becomes equal to 12.531. And that unwinding difference, if you remember, will go to P&L as finance cost, liability will be added up and it will go there. It is like your provision treatment. Then that is all with the standard. Next is IS 38, intangible assets, fair value is done. We have done the lecture. We have seen few simple illustrations from the book. And of course, we will be doing some questions from the practice kit to understand it much better.